All right, I see some folks joining us. Thanks for being here, everyone. I believe we're up to the last session of the day. It's been a great day. I'm glad you all have been able to join us for the entire day. And we're going to close things out this afternoon with a look at specialty tax services, more important than ever post-election. Isn't that the truth? And we have with us today to offer his insights, Jeff Kimmel. Jeff has consulted with ETS clients and CPA partners to identify, qualify, quantify, and capture tax benefits. Since 2010, he specializes in all ETS service areas to maximize the benefits of proactive tax planning. Jeff, thank you so much for being here, and I'm going to turn it over to you. Thank you.
Bill, my pleasure. Thanks a lot. Good to be here this afternoon. I don't know if it's good news or bad news that I'm the last of the day, but the pressure of being between everybody in the bar is always a tough one to deal with, So, Bill's going to kind of stay with us throughout the session. I understand if you all have any questions, please don't hesitate to pop them into the chat box. And I asked Bill, interrupt the conversation for any questions as they come up, just because if it's a topical question, let's answer it and we can move on to the presentation later. Okay. Appreciate it. Okay, so about engineered tax services, Bill mentioned a little bit who we are, what we do. I'm a regional director here in the Middle Atlantic area for engineered tax services, especially tax engineering firm. We have three companies that form our overall family. Engineered tax services, where I work primarily, we deliver cost segregation, R&D tax credits, 45L and 179D deductions. A sister company is the Growth Partnership. They're focused more on firm management and development, staff development. They do a lot of marketing and growth training and education, practice management. They issue the Rosenberg Report, among others. And then the third company that's part of the family is Inside Public Accounting. And they have a CRM system that's available to CPA partners. So we try to look at our family, our relationships, if you will, on sort of a broad basis rather than focusing just in one little area of our relationship. So we want to talk today about the upcoming major tax rewrite that everybody knows is going to happen in 2025. I think the specialty tax area is going to be front and center in a lot of those areas that are going to be addressed. And I think you're going to see a lot of client questions. There's going to be a lot of publicity. It's going to be publicized by both parties, has been for years. It's going to continue that way. There's going to be pundits sending out podcasts and all that about it. And just what I'm trying to do today is give you a little feel for what's going on, what I've seen has happened so far, what to expect, and maybe how to talk to your clients as questions arise. I think the fiscal concerns our country has now are going to impact the final design and structure of what happens, what gets passed. In 2017, we weren't funding two major wars, and we are now. So the amount of resources we have to throw at a tax bill are not anywhere near the same as they were back in 2017. That being said, the cost to extend all of these TCJA provisions, $5 trillion over 10 years. That's T, not B or M. But T for trillion, a big price tag, and that's what has a lot of people concerned about how the structure is how the final design is going to come out. Don't expect any help from the omnibus bill at the end of the year. I don't see them doing anything that touches tax in any way, shape, or form. They're going to punt the ball to the new administration. They've got to focus on the deficit. Congress will have to focus on the deficit before they address any kind of a tax rewrite. And increasingly, folks feel like it's going to be a prospective rather than retroactive implementation of these changes. As you saw earlier, it's a $5 trillion price tag to make them all retroactive. That has a big impact on how it rolls out for your clients and how your clients and you will deal with it. The common feeling is third or fourth quarter for something to be out. Some folks think it's going to be sooner. Keep in mind, there's a new Congress starting in January. They have to elect a Speaker of the House. And as you know, in recent years, that's been a very contentious process. It hasn't been very sticky. It's turned over an awful lot. So that may be a delay getting things off the ground. All that being said, I expect the president-elect to exert a lot of influence and pressure and sort of make his presence felt throughout the design and the work that goes into the tax plan. Speaking of the president-elect, he's made a lot of comments on the campaign trail. He says he wants to extend TCJA provisions permanently. He talked a lot about the climate change hoax, which I know you've probably all heard of many, many times. He's expressed a desire to end the Biden initiatives in the Inflation Reduction Act around EV development. I think there's some changes are going to happen around that, but I don't think it's going to be repealed and replaced in any way, shape, or form. One of his big goals is to reinstitute 100% bonus depreciation. And if you weren't all on mute, I'd be hearing a lot of clapping in the background, I'm sure. He talked about expanding the research tax credit as well. But also, he talked a lot about SALT and tip and overtime income and not taxing Social Security. And there's a lot of moving parts out there and a lot of things that affect individuals, not just property owners or business owners or CPAs, but Bill and myself individually, personally, we have a lot riding on what happens here. So that's why I said earlier, there's going to be a lot of conversation about this. It's going to be it's going to dominate the news as work goes through it. Tax brackets, the standard deductions, all that stuff is on the table in 2025. Lastly, I want to touch on the T word, tariffs. He's already talking pretty strongly about tariffs. He'd like to see a 21 and 15% tax rates on the corporate side. I don't know if we can do all of those things at once, but one overriding factor that I want to make you aware of, you may not have seen or heard this yet, but there are 12 new senators elected this year. So a full 25% of the Senate is new players. People who have not been in Washington before, haven't been in the Senate. People tend to think they're more deficit hawks and they don't want to spend a lot more money than we have. So there's a block of 12 new, 4 Democrats, 8 Republicans who can influence or block any major legislation. So they're gonna have an impact on what the final result is, I think, before it's all said and done. I try to include this slide in every one of my conversations. Just a reminder, as you all know, the law says you have to file and pay taxes, but it doesn't require that you leave a tip. And the inference here is that if you or your client can qualify for some of these specialty tax services we're going to talk about, and you don't take advantage of them, you're overpaying your taxes. The tax law is there for you to utilize and take advantage of and understand. And that's the role ETS plays. We're here to help you understand your opportunities under the tax code, help you qualify and quantify them, as Bill said. And ultimately, what I want to do is make sure you and your clients are fully informed business decision makers about whether a study makes sense or doesn't make sense in their particular tax setting or situation. So the first one we'll jump into is cost segregation. You all know, of course, that bonus depreciation is sunsetting 20% per year. I like cost segregation. It's an easy, proactive tax plan. It's predictable because if you do a cost segregation study on a purchase or a renovation, you can project out 39 years exactly how much depreciation you're going to get from that building. So it's not a 1-year effort, it's a 39-year effort, and it makes people think in the future. And that's what we want as an important part of a good tax plan. I want a proactive partner. As I mentioned, widely applicable, new construction, new purchases, older buildings, no limits. As long as it's a commercial building, creating income in some way, shape, or form, it can be cost segregated. Cost seg studies, if you're familiar with them, are very helpful for you in identifying repair and maintenance or routine maintenance opportunities under the small business safe harbors. If you have an opportunity to expense an item as a repair and maintenance, do that. Do not capitalize it because it makes life easier for you and your client. Cost seg reports also support annual disposition of assets. If you put a new roof on a building, you're going to throw the old roof away. You should write that off and make sure that you don't leave that on your depreciation schedule. Always write off your assets in the year that you replace them. And then finally, IRS prefers this methodology, the full detailed engineering approach that we utilize. It's more precise, more accurate, and it's one of the six study methods they've approved. This is the highest, most accurate one, which is why they prefer it. So what is bonus depreciation? It was established by the TCJA back in 2017, and it says any asset or building component that has a class life, a depreciation life less than 20 years. That's all your 5 and 15-year stuff, your personal effects and your land improvements. They can be written off 100% in the first year of ownership. And that was the definition of bonus depreciation when it was enacted. And as you'll see in the next slide, 20, 25, 30, or even more percent of a building could be written off in the first year. I have some folks who are doing car wash and self-service, self-storage properties that are writing off over 50 or 60% of that property in the first year. All depends on how the property is constructed. Obviously, front-end depreciation creates additional cash benefits in reducing tax liabilities. So here's one of these eye chart slides I'm going to show you here. This is a list of a variety of types of buildings, and we show an orange block, which is kind of the 5-year personal property, and a dark blue block, which is land improvements, the 15-year. So if you look at resorts on the left-hand side, you see there's a 28% of that is personal, and 12% is going to be land improvement. So you can write off theoretically 40% of the cost of a resort property in the first year. And it's all over the place. There's 36 for medical buildings, 35 for hospitals, 36 for auto dealerships. Again, any kind of building that's out there that's producing income, generating income, you really ought to consider a cost segregation study, because there's significant benefit out there that's available for you and your client. So that we said it's sunsetting, obviously, and you all know that starting in 2023, bonus depreciation went from 100 to 80 to 60 to 40 to 20. It's ratcheting down 20% per year over 5 years. I think cost segregation got a lot of notice because of the bonus depreciation that was put in service by the administration. The big change that in the Trump plan of 2017 was he added bonus depreciation for existing properties. Previously, when there was bonus depreciation allowed a couple of years here and there, it was only on new construction properties. Now it's any real estate property. The other thing bonus has done is it made lower value, lower basis buildings more relevant and able to benefit from cost segregation. I hear a lot of clients say, oh, it's got to be $1 million property or more before it makes sense to do bonus depreciation or cost seg. That's not true, really. I use personally about $500,000, and frankly, we're doing studies on properties as low as $150,000. Because of bonus depreciation, they're still very accretive to the client. And we'll look at some of those numbers and comparisons in a couple of slides. And again, I think don't be overly concerned that bonus depreciation is sunsetting, because I'll show you in a bit why I think whether there's 100% bonus or 0% bonus, a cost seg study still makes more sense from a tax perspective than just not doing a study at all. It's a chart here of a project I did back in 2022. I'm comparing a $6 million new build. I'm showing you straight line on the green here at the bottom, 0, 20, 40, 60, 80, and 100% bonus depreciation. And just overlaying that all in one chart, showing off my wonderful Excel graphing skills. You can comment favorably if you'd like. But you see in the first year, obviously, huge difference in the amount of depreciation benefit. But as you move to the right along the continuum, at 5 or 6 years, you almost have the same amount of depreciation available, regardless of what the bonus percentage was. And by 10 years, you're almost identical. So in this case, this guy has another 19 years where it doesn't matter whether it was 0, 50, or 0, 40, or 100%. He's got the same depreciation for the last 19 or 20 years of the property life. And here's the chart that was the source for all the graph numbers. Let's focus on the first column, the straight line depreciation. And this is that same $6 million new build project I mentioned earlier. You see the first year is only 32,000 and it jumps to 154 thereafter. That's because it didn't get placed in service until 10/19. So that's why the first year is low. But if you compare straight line to 0% bonus, first year, it's $190,000 less. And it's just significantly better to have 0% bonus, which is the classic maker's depreciation. Take that 0% bonus and you're still way ahead compared to straight line depreciation. And you see 20, 48, 68, and 100%. Obviously, with 100% bonus, you get a significantly larger depreciation deduction than 0% bonus. My point is, look at this as a 5 or 10 year decision, not a 1 year decision. After 5 years, I've highlighted yellow. The straight line depreciation user has $650,000 on this project. The maker's depreciator, even at 0% bonus, has 1.5 million almost $1 million more. It's $900,000 greater depreciation over 5 years because they did a study. So again, harping again on the point of don't worry about cost segregation or don't leave it behind just because you don't get 100% bonus. If you look across the 5-year line, the numbers are still a little different, but markedly closer than they were in the 2022 line. And then as we get down to the 10-year line, I see a couple of questions, Bill, and I'll let you jump in a second. The 10-year line, the difference is almost totally eliminated. Once you've depreciated a property for 10 years, all that's left is the tail end of the 15-year and all the 39-year property that's out there in the building. So again, look at it as a 5 or 10-year decision horizon, not just a 1-year decision horizon. Were there questions, Bill, you want to?
There was one that came in here, Jeff, and it reads, is there anything wrong with a client identifying their 5, 7, and 15-year property without a full cost segregation study?
There are various levels of cost segregation study. That's a good question. We tend to use the full engineering detail study. It's going to be more expensive, but it's also going to give you the best results. The lowest level of a cost seg study is called a limited scope study, IRS approved, and you use square foot allocation and industry standards to come up with the engineering combination or content of the property. That works well, but generally in our case, if it's at ETS, the limited scope might cost 50% less than the full detail study. But the benefit you get is 15 or 20% less in depreciation benefit. And generally, you're giving up more value in depreciation benefit than you are saving in fees. We kind of call it stepping over dollars to save dimes. But there may be a situation where fee is a big concern for a client. A limited scope study is still very accretive. It just won't be quite as accretive as a full detail engineering study. There are some clients who will do a cost seg study off of an AIA invoice on a new construction program. I've seen that a number of times. The challenge you have when you do it personally or do it sort of offline without engineering input is you may wind up may not having as defensible a position if you're ever audited on that particular project. Okay, we're good, Bill, on questions. Yep. Okay.
Yes, we are.
Okay. So how do we deal with all this? Couple of options and responses. I promise I give you some ideas on how to deal with each one of these 3 areas. I've had people tell me I'm going to delay closing or the place in service into 2025 because I'm sure there's going to be 100% bonus available in 2025. There's no guarantee, but that's a discussion that people may want to have with you. Let's not put it in service until next year. Let's roll the dice and see if we get a better deal on bonus depreciation. The one trade-off, obviously, as you all know, is you're giving up some time value of money because you're not taking that deduction in 2024. You're waiting until 2025 for it. There are those who think it's going to be retroactive. You can extend 2024 and wait for Congress to get around and do their thing. Your challenge here again is going to be you're going to have to make a tax payment based on 60% bonus. You can't not make a tax payment assuming it's going to be 100% because if it doesn't happen, now you got late fees and penalties, and I hate late fees and penalties. I think it's a waste of money. So again, if you're gonna roll the dice and think it's going to be retroactive, just make sure you make the tax payment based on 60% bonus. Don't overlook cost seg. I think I beat that horse dead on the last couple of slides. It's still very useful, very valuable, very accretive, whether it's 0% bonus or 100. So keep that in mind. Keep an eye out on look back opportunities. I'll show you a chart in a second that'll show you how valuable look back opportunities can be. I can go back and study a property was placed in service 10 or 12 years ago. And you can do a current year adjustment and a form 3115 and post the adjustment in the current tax year, not have to go back and amend 12 tax years. It's a nice benefit the IRS did for us. Don't forget about inheritance and 754 step up in basis opportunities. Good opportunities to do cost segregation studies and maximize the benefits of those transactions. $250,000 or less in building basis, $50,000 or more in improvement projects, still real strong metrics for a cost segregation study. So don't be self-censored by thinking it has to be $1 million project or more to make sense. And of course, I talk about that in the first example I give you was a $5 million project. So just to give you a sense of the impact of bonus depreciation, there's another study I did for a multifamily project outside of Philadelphia a couple of years ago. $5 million cost to construct. The owner got a $1.55 million first year tax deduction through a cost segregation study. Compared to straight line depreciation, $661,000 increase in net cash flow on an after-tax basis. And that's an awful lot of a good benefit. So just it's a little bit of an extreme example, but understand there are $20 million buildings, there are $1 million buildings, but there's value out there in all those sizes and quarters. I mentioned look back studies. This is a $5 million multifamily property project. They decided to do a cost seg study 5 years after they put the property in service, and they got a $387,000 net increase in cash flow improvement by doing that study. The look back deduction was $902,000 compared to about $180,000 on a straight line basis. So again, look back studies are very powerful and they can add great value to you and your tax plan. The research and development tax credit, I think some of you may have heard about this in some detail earlier today. This is the real lightning rod of the TCJA sunsetting items. It's supposed to be an economic stimulus and encourage job stimulation, but it's actually been a deterrent and a cost tax increase in practice. Amortization is kind of the lightning rod I mentioned earlier. Beginning in 2022 tax years and beyond, you're supposed to amortize all of your R&D related expenses, not just the direct expenses, but all of the expenses, the so-called 174 expenses. US-based innovation has to be amortized over 5 years, international costs over 15. what I think this does is it exposes about 80% of your annual R&D expenses to an income tax liability. Previously, we're all able to say, I spent $100,000 on R&D expenses this year, and you could expense all of that under Section 162. If you have to capitalize it and only use 20% of it, now $80,000 of my previously expensed items are now subject to income tax. So I'm looking at a significant tax liability that I didn't have before. And that's going to happen for 5 consecutive years until we get through the cycle of fully amortizing all of our expenses. Also note that the Section 174 expenses, as identified by the IRS, so-called indirect expenses, are at least 20% and generally 30% more than the qualified research expenses that you're using to calculate your R&D expense. So if you had 100,000 in R&D expenses, you probably have 130,000 or more in indirect or Section 174 expenses. Chart we got from the IRS, and it gives you that bullseye on the right, as you can see. The darker blue on the outer band is all of your expenses. Lighter blue in the middle is the Section 174 indirect costs, as you see listed here, and the R&D Section 41 costs, which are the direct costs we use to calculate the R&D tax credit. And then the bullseye, of course, is the Section 41 only costs that are the direct qualified research expenses. That's what we use to calculate your R&D tax credit. Make no mistake about it, the R&D tax credit has not changed. You still get the same benefit, the same value, the same calculation. The problem is that you cannot expense all of the items that went into R&D anymore. You've got to capitalize them. So this is one of the, you'll hear a term increasingly as we go through this, pay for items. This is a pay for item. The tax increase from the R&D tax credit is going to be used, was intended to be used to offset tax giveaways from other areas of the TCJA plan. Talking about amortization, it is a pure and simple 5-year tax increase. As I said, it's a pay for item. Actually, it turns out to be 6 years because of the way you amortize the expenses. The impact on your client decreases slightly each year. But I'm saying if you took R&D credit in 21, you better take it again in 22 and 23 because it's a real easy audit. You're leaving a real easy audit trail for the IRS to find you. Because if you're not amortizing R&D expenses, you're not turning in an accurate, correct tax return. So we're going to use, you have the ability to use a look back 3 open tax years to capture prior R&D expenses. 2021 taxes were filed in 2022. 3 years from now is 2025. So in 2025, I can still go back and study 2021 before amortization kicked in, and I can capture that total benefit, bring it forward, and use it to pay some of the tax liability for complying with the TCJA capitalization and amortization rules. But keep that in mind. Let the tax law work to your favor. In this case, it can. You can also look in cases where clients have losses. You can look back beyond 3 years in a loss situation. You can go back until you find a year that they could use the R&D credit. Right now, I'm doing a 10-year study for a manufacturer up in New England. They had a run of bad years. They're about ready to turn it around and make a lot of profit. We're going to pull all those R&D credits forward and offset tax for them for probably the next 5 or 6 years at least. Other area I want to mention to you is startups. Startup firms probably already in a loss position, pre-revenue, but they're allowed to get they can use the R&D credit for payroll tax to offset their payroll tax liability. That's 6.1% you're paying FICA and Uncle Sam. If you're less than 5 years old, gross revenue is less than $5 million a year, you qualify as a startup. And again, the cost of the study is minimal compared to the credits you can use to offset writing checks to pay for tax liability for payroll taxes. And a lot of startups have huge payrolls because that's why they've got to that's why they're in a pre-revenue state. Quick look on R&D tax credits. Do not forget state credits. As you know, Maryland has an R&D tax credit. It's 10% of your qualified research expenses over the Maryland base amount, and it's capped at 12 million a year. But again, it's another benefit that's available. If you qualify for a state R&D tax credit and you don't use it, you're leaving money on the table. You're becoming a big tipper for the IRS, and we don't want to be too big of a tipper for the IRS. So what are my options and responses for R&D? Interestingly, since amortization came along, California, Georgia, Tennessee, Indiana, and Texas have decoupled and don't make you amortize R&D expenses, which is just a pain in the neck for CPAs because you got to calculate their tax return two different ways. I know a lot of states have uncoupled from bonus depreciation, but now a growing number are going to add R&D to that as well. Just what we're all looking for, more work at tax time, right? Okay, reminder, those section 174, the indirect expenses, 2 slides prior, they're going to be at least 20 or 30% more than your qualified research expenses. 2025 is the hump year. It's kind of the 4th year of the pain of the plague of locusts we have to deal with here. You're almost all the way to the end of the line, if you will, if you make it through 25. Obviously, we'll talk about in the last bullet point, Trump wants to extend and reinstitute the R&D tax credit without amortization. We can't afford for it to be retroactive. It's going to be prospective, probably from 25 forward. They're going to stop amortization requirements. The challenge we have now is how do we deal with what's out there already? If people have filed their tax returns correctly, they've got actually not 180%, but more like 300% of their 174 expenses are on their balance sheet as an amortized expense. How do we unwind that? How do we get that money back? How do we get that benefit back? It's something we need to keep an eye on very closely as the conversation and the directions roll out on how the R&D change is going to be effective. You're going to have to wind up filing a Form 3115, change of accounting method. That'll probably be part of the implementation or rollout of whatever changes happen. Again, I would advise you keep an eye on that very closely. Just four items here for you on the 174 guidance and how to identify, document, capture, quantify, what have you. 174 expenses. There's 4 of them. And then incidentally, I was doing some casual reading this morning and I found RevProc 2025-23, which is another revenue procedure the IRS issued this morning that talks about additional clarification and guidance around filing that Form 3115. So keep an eye out for that. It's going to be published in early January. But the point is on the next slide, you'll see 2 years in amortization, there's accounting method implications. Be careful of taxpayers who have not addressed the 174 amortization beginning after the 2021 tax year. A lot of people said, I'm just going to blow it off because it's not going to stay around forever. It's not a good legislation. But now we're left holding the bag. If they avoided it and didn't take it, you got to address that some way, somehow. At some point, the IRS is going to get tired of chasing fraudulent ERC claims. And they're going to have all these auditors out there looking for things to do and people to talk to. I'm almost wondering if R&D amortization might not be the new ERC from an audit perspective. So again, take whatever steps you need to. These are not easy conversations to have with clients, but you got to have them to protect you and your client ultimately. Research performed under contracts. Sometimes the rights and risks that you're taking there might enable you to not record any of that expense as a 174 expense. So pay attention to contract research that's done, especially if it's government related. And then there's the QREs. Again, we talked about 174 expenses tend to be higher than QREs, and that's just not going to change ever. And then lastly, there have been changes to the 280C and also the Form 6765 that have happened in the last year or so. Need to keep an eye on that and be aware that it may make more sense for you to take the gross credit, not the net credit, but be sure and if you're not doing the R&D calculation, make sure your vendor partner is giving you the updated 6765 and all of the extra detail the IRS is requiring that be filed with your individual tax returns. Third area I want to address, we're okay on questions, Bill? I didn't see anything else pop up.
I've not seen anything new, so I think we're good. Yep.
Good. Okay, excellent. I'm going to jump into the energy efficient construction deductions. These are the impacts of the Inflation Reduction Act that was passed in 23. And it adjusts a benefit that's been out there since the Energy Policy Act of 2006. I'm sure many of you remember that and the introduction that Clinton and Obama made of that particular benefit. Another eye chart for you, but it's important. The line down the middle is kind of a huge stone wall, not a border wall, but it just a line of demarcation. To the right, any project that was completed prior to December 31st, 2020. Oops, sorry about that. Completed before December 31st, 2020 is under the old rules where the benefit was up to about $1.80 or $1.88 with the inflation adjustment. Energy efficient owners and designers could claim $1.88 per square foot one-time deduction prior to 2023. The Inflation Reduction Act did a bunch of things. Number one, it expanded the benefit by 3 times. So the maximum benefit now under the Inflation Reduction Act is like $5.83 a square foot. Significant increase. The other thing we did here that was really important was changing the definition of a public entity. We finally got around to adding nonprofit organizations, churches and other religious organizations, and tribal organizations. So now in anything that's done with a completion date, this is going to be important in a second. Anything that has a CO issued after 1/1/23, if it's a nonprofit, a church, or a tribal organization, it's now a public entity. The designer can take the allocated deduction for that project. And it's an expanded definition. So the playing field's a little bigger and broader for architects, design build engineers, and folks like that. So the point we want to make sure we look at is the start date of a project and the completion date of a project. I want to go to the chart just that demonstrates the strong difference between the $1.80 a square foot that the Energy Policy Act of 2006 allowed up to the new Inflation Reduction Act benefit. The Inflation Reduction Act says I got to look at a project, look at the entire building. I can't look at an individual system like I could under the Energy Policy Act. So I got to look at the whole building. I got to compare it. If the energy gain is 25% or more, you're going to earn a benefit under the Inflation Reduction Act. And you see it steps up every 5% of energy gain, the benefit jumps up 10%. And there's actually interim. If it's 27%, I think you get like 54 cents per square foot. What the Democrats put in, their employment and wage people at heart. So this piece of legislation has an employment and a wage category. It says you have to pay prevailing wages to qualify for the benefit extender or accelerator. You also have to hire apprentices on your job. At least 10% of the hours have to be apprentice hours. and you have to pay a prevailing wage. When you do that, the benefit increases by 5x. So you can see a 25% minimum gain, you go from 50 cents a square foot to 250 a square foot. At the upper end, the maximum you're going to get is $1 per square foot if you have a 50% energy gain over the baseline. Now that becomes a $5 per square foot. So again, very rich benefit. There's a little bit of a stickler in it because of the employment and the wage benefits that are out there. But again, it's important to pay attention to that in your discussions with your clients. Any projects they're doing, make sure you think about stacking benefits. I call that, so I'm building a new building. You want to take the cost segregation study benefit, obviously. You want to tack on the energy benefits on top of that, because that's stacking benefits. The project will qualify for both of them. Don't just ask one question and walk away. Option responses for the energy responsibility changes. First of all, the 45L deduction, which is part of the Inflation Reduction Act, that's a tax credit. The Inflation Reduction Act made the qualifying hurdles way too steep. We have not done a 45L, successfully done a 45L study since the Inflation Reduction Act was implemented. But you can still focus on legacy 45Ls. Anything that was built and had a CO issued in the last 3 years, I'm looking at a garden style apartment, 3 stories or less above ground. They can still qualify for that legacy 45L benefit of a $2,000 per unit tax credit. So think about looking back and the stuff that got implemented in 2022. There's a lot of benefit there. On the 179D projects, we have found that engineers, contractors don't want to go through the headache of tracking all the wage data and the apprentice hours. So I'm telling my clients to focus on projects that started, had a shovel in the ground, started before 1/29/23. IRS and Treasury has said if you started work before that date, you're grandfathered in and you get the full 5x multiplier on the benefit without documenting prevailing wage or apprentice hours. So it's a great benefit. It's low-hanging fruit. A great example of don't leave a tip if you don't have to. We can go back, like I said, I don't care when the project finished, as long as there was a shovel in the ground by that date in January of 23, you get the full 5x benefit. Designers, I'm sorry, Bill, go ahead.
No, I was going to say we had a quick question, and I don't know if you had already answered it to this effect, but a related question. Do you expect 179D rules to change at all?
That's a good question. That's the kind of question when clients ask me, I answer it by saying, tell me what you think is going to happen, and I'll tell you why you're right. I can argue both sides of the coin.
Mm-hmm.
At his heart, I mean, Trump's a business guy. He's a real estate guy. I think he likes the 179D benefit because it's a real estate oriented benefit, if you think about it in its essence. He doesn't like some of the EV stuff that the Democrats put in the Inflation Reduction Act, and I think he's going to go after that, and he'll get rid of those, and maybe some of the wind credits and things like that. He'll call those pay-fors. Remember, I'm going to take back a tax benefit. I'm going to use those dollars to pay for other stuff I'm going to give out. So I don't think 179D is going to be a pay-for. Maybe they'll get rid of some of the requirements about prevailing wage and apprentices and make it just a little more reachable for everybody. But didn't really talk much about it in the campaign. So it's a long-winded non-answer, but it sounded good though, So on the 179D benefit, don't forget designers as well as private owners qualify for that. So your architects who are designing major projects, I've got somebody who is building a 650,000 square foot apartment complex in Brooklyn, of all places. He started work at the end of 2021. This guy's going to get a $3.5 million tax deduction on that project because he started before Inflation Reduction Act limitations went into effect for prevailing wage and apprentices. Look back, think about it. Don't forget about those look back opportunities. I'm focusing on legacy 45Ls, as I said before. I'm focusing on 179Ds that start prior to January 29, 23, and projects that are, say, 10,000 square feet and above. And don't miss the look back opportunities, please, because it's just money that's on the table. Any other questions before I kind of wrap up and make last comments, Bill?
No, there are
Good.
no other questions have come in. So I think
Okay,
we're great.
excellent. I want to thank you all for listening in and attending today. Again, I'll just kind of reiterate some talking points or high points. I feel like, I mean, I'm already getting questions from CPAs, but also direct clients who are not CPAs. What's going to happen to me? Do I need to extend to take advantage of the bonus depreciation? Is it going to come back retroactive? Just kind of prepare answers in your mind for all those kind of things, because I think there are conversations you're going to have with all your folks. If you don't raise them, they're going to raise them at some point during the tax planning process. And I think there'll be a lot of people out there in the market talking about some of these opportunities that are going to be created. Look back, look back, look back. Please don't forget about those. All three areas we talked about today, cost seg, R&D, and energy, have real big time valuable look back opportunities. I've done cost seg studies on properties that have been in service for 15, 16 years. We do a benefit analysis on every project we consider, so you'll know up front whether it makes sense to study that project or not, that property or not. But think about all that depreciation catch-up benefit you get without having to do an amendment to a previously filed return. That's something you want to take all day long. I mean, it's just free money. R&D look backs, remember we talked about, it's a little bit of an obscure point, but you can look back into 22, capture the full benefit before amortization hit, and use that to fund the cost of compliance for 22, 23, and 24. So use the law creatively to your effect. And then certainly with energy, excuse me, sorry about that. With the energy areas we talked about, legacy 45Ls and man, those 179Ds where the shovel hit the ground before 129.23, great benefit for your client. You want to make somebody happy, give them a $3.5 million unexpected deduction on a project in Brooklyn. And not to brag at all, but this guy's working on a 3 million square foot project in Miami. And I think I might have the inside track of getting that business too. So use that to your advantage. You know, be a friend, be an advisor to your clients, and have your answers ready or answer their questions before they raise them. Hey, you guys have a great day. Enjoy the holiday season. Don't worry about going out and looking at RevProc 2023-25. That'll all come after the new year, okay? But just keep your ears to the ground. There are going to be some good stuff out there. There's going to be some conflicting information, but you want to be the source of reason. You want to be the voice of reason with your clients. People who need these things are your more valuable clients. They're ones you want to walk away. So make sure they hear it from you, not somebody else first. Bill, it's all yours. Have a great day, y'all. Thanks so very much. One last question or no? Did I see it?
Nope, I think we're good.
Okay. All right.
Thank you. Jeffrey, thank you so much. Great session. Lots to digest there. Thank you so much.
Bill, thanks a lot, buddy. Appreciate
All
you
right.
riding shotgun. Take care now.
Take care.